you see that in our portfolio all the time. You see people who are giving up too early, and you see people who are just breaking through walls to make stuff happen. That breaking through walls, tenacity is one of the most crucial things in a founder. The other I'd say that like comes top of mind is speed.
Welcome to Money Moves, the show about raising money, making great investments, and building venture scale businesses. I'm Neil Devani, your host and the founder of Necessary Ventures, a firm investing in what the world needs. Each week, we'll talk to folks who have raised anywhere from $10 million up to billions of dollars. We'll learn how they return multiples of 10x to 100x or more to their investors. We dive into their stories, uncovering what worked and what didn't, learning from real experiences to understand the journeys of raising capital and rapidly scaling a business. Money Moves isn't just for those already in the game. It's also for anyone interested in the mechanics of startups and venture capital. Whether you want to raise money, make better investments, or just understand how it all works, Money Moves gives you the insights and advice you need to succeed. So join us each week and hear from those who've been through it all and learn from their journeys. This week, we're talking to Sheel Mohnot, founder of Better Tomorrow Ventures, a fintech-focused fund with almost $400 million under management. Sheel has also built and sold several companies. We have a very special guest co-host this episode, Sheel's wife, Amruta Godbole, who serves as Associate General Counsel at Instagram. Sheel and Amruta, thanks for joining. I appreciate you guys being here.
Thanks for having us.
Thank you.
So to kick things off, Sheel, can you just talk a little bit about how much money you've raised over the course of your career, from companies to funds? Have you ever done the full math of it?
Never done the full math. I think so. Fee Fighters was small, only raised 1.6 million. Although at the time, in 2010, that was considered like a pretty good size of a seed round. Now it probably would be considered pre-seed or relatively small seed. And then 500 Fintech. So backstory is there was Fee Fighters. Then I had an auction company that in the auction company, we never raised any money. And then 500 Fintech. So 500 startups, I ran a fintech specific fund that I raised and ran. It was relatively small, 15 million. And then we started BTV, end of 2019. And fund one was 75 million. And then fund two was $150 million, the seed fund. And then we also raised a opportunity fund that's like another 75 million. So that's 225 in the last set of BTV2 funds, 75 BTV1. So that's a total of 300 million plus 15 from 500 FinTech, and then 1.6 from
We got to make sure to add that 1.6 in there. We can't leave that out.
Yeah. So I guess that gets you to 316.6. But that actually leaves out a bunch of SPVs. That's probably like another 75 million, roughly.
I want to come back and ask you about some of those raises, like the experiences you've had. I want to make sure we also just note on the investing side, you've had some great investments. What would you say is your best investment so far?
It's interesting. I would say my best investment is actually on the call with us right now.
That's a great answer.
It's you, Neil.
Honored. Thank you.
Aside from Amruta, I think a lot of there are some investments that were good from a returns perspective, already returned, and there's some other investments that have been good from a branding perspective. They're companies that like I believed in that no one else did, and they worked out. And so those tend to be good. I think from the 500 FinTech fund, those are Albert. It's consumer financial product. They have a neobank and a bunch of other products attached to it. I think nobody really wanted to invest in the company. I got really excited about the CEO. Company's done really, really well. It's a profitable company with hundreds of millions of revenue today, and probably could go public in the next couple of years. Kin is a homeowners insurance company operating in catastrophic areas, and same thing, was never the like Silicon Valley darling company. There's another company called Hippo that was, and Hippo raised tons and tons of money, and then now actually Kin is a much better company. I think like my early belief in those companies has been good for me, sort of professionally, and then also like in figuring out what I like.
What about the ones that you think are in the other category? The ones that maybe are those probably are pretty good returns, given that you did them from 500, right?
Yeah, so I mean those are great returns because our entry price on those was 2.5 million post, and now they're both, yeah, last round of both of them was over 1 billion. So they are good from a financial perspective too. I think they may not be the best from a financial perspective, actually. I think in the personal portfolio, Flexport has been a good one. It was extremely highly valued in 2021. Supply chain was going through a bunch of crazy stuff. I sold some shares at that time, and that sort of markup was quite large. I actually don't know which one would be from a multiple perspective, like which of our portfolio companies would be the highest returning. Those are a few good ones.
It's good timing as well on that one.
Yeah, so much is good timing. I think one thing that people really miss in this business is that as an asset manager, you are responsible for buying and selling. And I think a lot of people just completely forget about the selling part. And they're like, oh, we're never going to sell. But there are great reasons why you need to figure out when the right time to sell is. And
Jill, it's interesting to hear you say that since this is
that's funny. Okay, so
one of our frequent personal debates is about when to sell.
yeah, the backstory there, it's funny.
This
Good thing you brought
co-host
her
is
on.
working out really well already.
Yeah. Okay. So I have been holding on to Nvidia for a while. I bought in 2017. It's probably been my largest holding for a couple of years now. And Amrita has constantly been telling me to sell, and I have not been selling. And I think when she started telling me to sell, the stock was like at least half of what it is today. So it's been so far the right decision. So I guess I would say like you, it's not that you only have to buy and hold. Like I don't think I'm going to hold Nvidia forever, but I don't know. I'm just waiting for a sign. I did think that perhaps the right sign was Jensen Huang signing that woman's breasts. I thought maybe that was a top signal. And I think actually the stock is
We
trading
should,
below where it
yeah,
was
we
then.
should track that. We should map that onto the like graph of the stock price in the last month because it has gone down. Maybe that was the top.
I think it's possible that that was the top. I literally
Or,
thought
or
about
like
selling.
a local maximum, let's say.
Yeah, it wasn't the top. It wasn't the top, but it might have been. Okay, so I'm checking the math here. That was on June 5th, it looks like. June 4th. And the stock was at 122, and today it's at 117. So not that different.
Not dramatic, not dramatic. There's this famous Bill Gurley interview where he's talking about bubbles. He's talking about like .com and also reflecting, I think, on the GFC. And he's like, I think he said something along the lines of, the best way to invest during a bubble is to just ride it off the cliff because you don't know how long it's going to last for. You don't know how much higher it's going to go. So just hang on, which seems to be a little contrary to the idea of knowing when to sell. But I think there's some truth in it given the uncertainty, right? Of like, how long can this go on for?
Yeah, it's hard to know. I think the right thing to do is like trim along the way, which is what Amrita's been telling me to do, and I have not done it in NVIDIA.
What
But
about hedging it out as like a compromise? You could like use some options and hedge it out a little.
yeah, I think that's a reasonable way to play it. Where I think I've caught some lumps is certainly a lot of our companies were overvalued in 2021, like everyone. And we had some companies that I had, if I tried hard, I probably could have sold and returned one plus turn of our fund. And I'm definitely kicking myself that I didn't do that in
Mm.
2021 when I had the chance. So I think it's a lesson learned that probably like a lot of people have to learn the hard way, and I've certainly learned it.
Sheila, I have a follow-up question for you, which is how do you square like that desire to do right by your LPs and, sell when returns are good versus your belief in your portfolio companies and wanting to both your actual belief and then wanting to like prove to them that you believe in them long term?
Yeah, I think so. First of all, like it's not like I have full faith in each of my portfolio companies. Like I did when I made the investment, and then I might have learned something along the way that's changed my mind, and that's totally fine. If there's an opportunity, if somebody else believes in it more than I do, I should make that trade. But I think when I've had discussions with CEOs about trimming our position, nobody took it the wrong way. Everybody said, yeah, like I understand, like this is going to be a meaningful return for your fund and you're still holding on and having upside. So it's been totally fine from the CEO's perspective. Nobody's ever felt like I'm giving up early or anything like that.
I want to flash back all the way to Fee Fighters and also go back to fundraising. Can you take me back to like, where were you? I believe you were in Chicago when you built that company, but like, where were you in your life? What were you thinking about when you're like, okay, I'm going to go start a company?
Okay, so backstory. I didn't start the company. Sean, my friend who's the CEO of Kin, he started the company. We worked together at BCG. We started out of grad school on the same day at BCG, and he left a few months before I did to start the company. And I think the impetus for the company was him and actually myself getting ripped off on credit card processing and wanting to solve that problem. So Sean originally started a blog helping other businesses not get ripped off on credit card processing. And then that blog evolved into this company. We had a marketplace where merchants can give us a few pieces of information and processors basically like bid down for their business. And it was a good business. And I learned a lot. Like it was my first foray into anything startup related. And
Jill, how did you decide to join Sean and like become a co-founder instead of like and leave your cushy BCG job?
I was debating at that time a few different things. While at BCG, I knew going into BCG that I wasn't going to stay. I had split my summer between Amazon and BCG, and I was like debating going to another tech company like Google or something like that. And so BCG was like a stepping stone. And actually, what happened was when I worked at Amazon, my boss had actually worked at BCG and came in at a higher level than you would have if you just went straight to Amazon. So that was kind of the impetus for me to going to BCG. And then at BCG, I just started thinking about what was next, like maybe a year in, and it took a while longer to leave. So I was considering three different things. One was I had actually, and Amrita, I don't think we've ever talked about this. I had actually co-founded a different company that was called Codio, and Codio was a company that was in the recruiting space, and the idea was you could automate coding tests to help phase one of recruiting. And we were going to start there, and we had a bunch of other applicant tracking and other stuff that we were going to build, but it was in the technical recruiting space. And I had two co-founders for that business. That company, we actually applied to YC for that company. And at the same time as I was doing that, I had been talking to Sean, and then we didn't get into YC. And then like I just didn't have that strong a relationship with my co-founders in that business. So we decided not to do that business. And I said, Sean, like, let's do this. And so we did that. There was actually a third business that I was considering. And it's kind of funny. So Uber had just come out at that time, and it was black car only. And they didn't have the Uber X business yet. And I was tossing around this idea that I called poober internally, the public Uber or the poor man's Uber or the just the poo burr. And
Great
it
branding.
was it was an internal name. That would not have been. And the idea was basically, what Lyft Line and Uber X became. You know, I don't know that if I had done it, it would have done well. Probably not. Um, but sort of shortly after that, actually, I think it took a little while before UberX launched and Lyft, and then there was also Sidecar at the time. But
Mhm.
I was doing some experiments on that as well. But really, the more serious ones were Codio and Fee Fighters, and ended up at Fee Fighters. And then you asked about fundraising. It was a different time and a different place, Chicago. And at that time, raising money for a company outside of the Bay Area was very difficult. A lot of investors told us, like straight to our face, if you move to the Bay Area, I will give you a term sheet. We're not going to invest in a company in Chicago. That is mostly not the case today. I think there are probably a few investors who are old school who probably wouldn't invest outside the Bay Area, but for the most part, that's changed dramatically. So we raised money mostly from Chicago area investors. There were a bunch of them. There was like this angel group that was called Hyde Park Angels. There was this guy, Jason Heltzer at OCA, who is a professor at University of Chicago now. I actually have had his students as interns twice, who is now at a different fund that was an investor. And then probably most notably to me, actually, was 500 Startups. 500 Startups invested in Fee Fighters, and that's where I built a relationship with them. And then, years later, I'd stayed in touch, and they asked me to join them in 2015. And I think that is what really put me more on the career to venture capital because honestly, no one else was willing to give me a chance.
How did you find those investors like Hyde Park Angels and 500 at the time had a brand, right? I imagine you just applied there, but like for these other folks, how did you find them? How did you know to go to them?
Yeah, actually, it's interesting. So, first, what happened was Angel List at the time was literally a list of angels. And so we got in touch with Naval, who ran Angel List, which was like, I think it was like a Google group of angels. And he posted our information there. And then Dave actually responded and said, I'm interested in meeting. And he was coming to Chicago for something, and we met up. Everyone else, it was kind of like a networked. So the company, before I joined, the company was going through an accelerator. And I joined sort of like right at the end of that. The accelerator was called Accelerate. It was based in Chicago. It became Techstars Chicago. And, we met a bunch of investors through that.
So you guys did Techstars and 500.
We did not do the 500 accelerator. 500 just invested in the company.
Got it. Did you have like a pretty high conversion rate on that round, or were there a ton of no's?
Tons of no's. And then we were out trying to raise an A, and it wasn't like we were running out of money, but we were thinking we were in a good position to raise an A. And it was tough. And it was primarily like people said, if you move to the Bay Area, I will give you a term sheet. And we just couldn't convince the team that that is what we needed to do. And the acquisition offer from Groupon came. It originally came as like a let's chat. We thought they were going to invest in our round, and then it sort of quickly snowballed into a like we want you to meet the rest of the team, and here's an offer, super low ball offer, and then negotiated to where we ended up.
When you look back, was there ever a moment where you were like, this isn't going to work. We shouldn't do this. Whether it was like the first raise or going out for the Series A and having some of those M&A conversations, or did you have like full confidence the whole time?
I wouldn't say I had full confidence the whole time. What I would say is I have very selective memory, and I don't remember. I'm sure there were times that it was awful, but in my like looking back at it now, it seems really rosy and like, it's been over 12 years since the acquisition, and I'm friends with all the team still. Like, Sean and Stella, they were at our wedding, but there were definitely intense, heated moments where somebody wanted something and I wanted something else, and we were at each other's throats. But, those things didn't last very long, and we were friends again pretty shortly after.
Self-awareness about selective memory is a great thing to have when you have selective memory.
Yeah, I definitely
Uh,
have it.
when you think about your experience as a founder and building companies, what do you think were some of the things that you were best at, like the core skills?
I think there's like some strategic thinking through sales. Like so much of the business is like go to market and business development. And I think that was always where I thought I was my specialty. In the Fee Fighters days, we did the first BD deal with Square. When Square was getting started, we worked with Stripe early on a little bit. The next company, the auction company, so much of the business was business development, and it was like getting in front of people through whatever means necessary. And my co-founder actually, I think, said at our wedding that I would do anything that it took, including I picked up smoking cigarettes, which I do not do and find disgusting. But one of our customers smoked cigarettes. So in order to spend more time with him, I bought a pack of cigarettes and started smoking it just so I could be outside smoking, talking to him about the deal.
That's commitment. That's real commitment. Do you look for that in founders now to see like that sort of drive?
Yeah, I think it's like you have to be willing to break through walls to make stuff happen. And I think that's so much of the business because like you said, it's hard. Even though I have selective memory, I know in my mind it was hard. And there are times when you want to give up, and sometimes it's easy to give up. By the way, sometimes it's hard to give up, but sometimes you just feel like it doesn't make sense for me to keep doing this, and you want to give up. But other people are just like, let me find a way through this. And you see that in our portfolio all the time. You see people who are giving up too early, and you see people who are just breaking through walls to make stuff happen. And I think that breaking through walls, tenacity is one of the most crucial things in a founder. And then the other I'd say that like comes top of mind is speed, speed of execution. Just like, are you moving forward every day?
I've seen folks start talking about this, basically knowing when to be tenacious and to show grit, which is obviously like the highly indexed quality, but also how to know when to pivot or just give up entirely. And it doesn't feel like there's really a clear answer to that. But have you heard anything or have you seen anything in your experience that's like a good heuristic to use?
I haven't. I've also been looking for one. So if you see one, let me know. I think there's like, it's like in product market fit, when you have it, like there's customers, there's like just so much customer demand. And then this one, which is like knowing when to give up, it's it's also something where you just kind of know it's time and you talk to enough people and you might try a pivot. You might try like a micro pivot or a more major pivot and see if that takes off while keeping the core thing going. And we've seen that work as well.
I don't have a great answer, but I'm a big fan of trying to bring like structure, like quantitative approaches to these kinds of questions when it's a very open, vague thing. And I've been thinking about with this podcast and also just generally benchmarking, how many pitches does it take to raise a pre-seed or a seed or a series A? What's the standard deviation on that average? Where should you benchmark yourself based on your company's progress, your background, what sector you're in, things like that, and start to give founders an understanding of like what the data suggests. Because if you look at TechCrunch, where people say publicly, it's like everyone raised their round in 2 weeks.
Yeah,
They got a term sheet real quick and they moved real fast. And we know that's not the case, right?
totally.
So how do we get some real data on it?
And even if they did get the term sheet in 2 weeks, um, there might have been like a mountain of work that they did prepping for those 2 weeks.
Yeah.
And people don't talk about that. So yeah, I think I know companies that have tracked it and have spoken to over 100 investors for a seed round.
Mm-hmm.
And actually, like I remember talking to Ken Lin at Credit Karma. Obviously, ended up being super successful, $7 billion acquisition right into it. But I think he tracked it, and there were like over 150 no's in that seed round.
That's what it takes, right? I think.
Yeah, that's what it takes. And he was willing to break through, and like he took some lumps along the way. Like the valuations weren't great, but he got to where he got.
Here's a question for you, Sheel. So as you have progressed in your career as a VC, I feel like the nature of the companies that you're investing in and the options that they have has changed somewhat. So you mentioned like these 500 companies, you were the only one that believed in them. Whereas at BTV, they have other like they tend to have many options and it's more about winning the deal. So I guess to Neil's question of like, is there any correlation since you've now kind of seen both sides between the ultimate outcomes for these companies and the how easy it is for them to fundraise at the start?
Yeah, it's a great question, and I don't have a great answer. There are some companies that we invest in still that are like diamonds in the rough. Hopefully, they're diamonds in the rough that, were overlooked by other investors. And then there are other companies where there are five term sheets already when we start talking to them, and we're trying to prove our value at the beginning. Now, there's a pricing difference in those typically. So one, the variance in our companies between what we pay at the highest end at the lowest end is about 4x at the same stage, same everything. So, you know, there's a question of ultimate outcome, but I think where most people come out on this is venture is a game of grand slams. It's like the doubles, the singles, the even the home runs are not as valuable as like the ultimate crazy outcomes. And so most people come out that you have to invest in the companies that everyone else wants to invest in. And those are that are seen as the winners. We've had some luck there, but we've also had luck with the others. So I actually don't have a good answer. I actually do know though, if you look at our companies that are highest valued from Fund One, we invested in them at a 2 million, 8.5 million, 8.5 million, 12 million, and 15 million valuation. So that was kind of actually the full gamut of where we would invest in that fund. But it doesn't suggest that all of the highest valued companies were at the top.
And also it shows like you're not talking about like the most premium of pre-seed, seed, right? Because that's like 20, 25, even like 30, 40 in some cases for a first round.
For sure. And for us, for our business, we don't invest in those companies. It's just like the math doesn't work for a fund like ours. Obviously, you can run the math any way you want, and you can say that the outcomes are going to be so much better from those higher value companies. But we typically don't invest in those companies. So like we're generally in the sub 20 range.
There's a lot of like denominator problems in doing these analyses, but
Of
when I've
course,
looked at it,
totally.
like the most premium early stage rounds do not correlate, at least from what I've seen, with the biggest outcomes. Almost all of the biggest outcomes have had more humble beginnings.
Yeah. The thing with this business that's really hard is we don't know. Like we'll
Yeah.
know today's business in 12 years. So it's really hard to say anything. But we do know that some of the iconic companies had a lot of trouble raised at low valuation. Like we do know that.
Staying on the topic of fundraising, going from fee fighters and now raising for funds, what's been the biggest difference between the two?
One difference is for funds, it's not like you're on a tight timeline. Like you can do it while you're doing other stuff and invest. I think the best outcomes for a company are when you focus on fundraising for like a month. For a fund, it's different. Like we're always passively fundraising, and the same investors who backed us in Fund One, pretty much those same investors backed us in Fund Two. So it wasn't a lot of like going out to new folks. And that's a big difference. And which is why I think it's important for VCs to get capital that's going to be there for fund after fund. It's like, if you think about like you always want SaaS, recurring revenue, and like similar thing. Like we have a bunch of LPs who are with us in Fund One, with us in Fund Two, and they've already committed to Fund Three. And that's the kind of folks that we want. Obviously, like if we do our job, that's what it should be. And it should mean that raising isn't much harder every time. The other thing is in your sort of seed series A, B investing, typically you find a lead investor and the rest falls into place. That isn't really how it works in raising money from LPs. There's also like there's a lot of herd mentality that VCs have. Surprisingly, LPs, I haven't seen it. Like we have some LPs with the brand name, and it's not like once you sign LPX with a brand name, everyone else falls into line. Like does happen if you raise from a top VC fund. So kind of surprisingly, there's less herd mentality than you'd think.
What's the best experience you've had with an LP in the fundraising process?
The first thing that comes to mind is Sendana. It's a seed focused fund of funds. They were the first fund to commit to us relatively early in our process. In our first close, we only had, in that first close, it was primarily people that we knew personally and Sendana. What was really helpful about having them is, as I said, like, it's not like having them meant others fell in line, but they did a lot to make that easier. And the main thing they did is they did like 30 reference calls on us and they shared their notes with other investors. And I think that made things easier in our fundraise. So that was one thing that if, VCs are listening to this, try to do that. Try to have somebody who does a ton of work share their work with others.
What's the worst thing you've experienced? You don't need to name names if you don't want.
We had folks who had signed to wire money and just like never wired money. And in actually in 500 FinTech and BTV1, 500 FinTech, we had a entity that was like a fund of funds that never made a capital call, and it was like a significant portion of it was a high single digit portion of the fund, and ultimately it worked out in our favor because what happened was the fund it was like time for them to default, and the fund was already like performing quite well, and so actually Jake and myself bought that LP stake. So that worked out quite well for us because we bought it at cost and it was already marked up. We sort of ran it by our LPs and they were fine with it.
That's a nice turnaround of a bad situation. Did they just like not respond? They like give you like a story as to why they weren't?
I think there was a story, and then for a while they were non-responsive, and then we said, hey, like we have to default on this, and they never got back to us and we defaulted. And then that was in 500 FinTech. In BTV, we had it's a different situation. It was the pandemic, so we did our first close December 2019, and then we were planning to do a second close end of March 2020, and we had folks who had signed, beginning of the year, February or whatever, and then pandemic happened, and like they were just like non-responsive.
There was a day I remember like end of March where the market was down like 15-20%, like the S&P was
Exactly.
down.
So that was tough, and we actually, yeah, it's actually coming back to me. So okay, at that time we were planning to raise a $60 million fund, and then pandemic starts, market is down like crazy, and we actually sent an email to our LPs. So we'd collected about 20 million to that point of the 60 we were hoping to raise, and we sent a message to our existing LPs who had committed to 20 and said, you know what, guys, the market has changed. We are going to do a smaller fund. We're going to aim for 40 million, and that's okay. We'll still get the same ownership because valuations are going to come down. And boy, we could not have been more wrong. But what happened was, the money printer started, interest rates went to zero, and then that made our life easier on the fundraising side, where like even folks who literally had told us, no, we're not interested in your fund, came back and became LPs. And then we actually increased the fund size to our hard cap, which was 75 million. And then, valuations, of course, did not come down and basically went like straight line up. It was an interesting time, one that I don't think we ever got like sad about it though. We just thought like, okay, this is the new reality.
I think that's the mindset you have to have, right? Just kind of keep moving through things. You've fundraised for a company, you fundraised for multiple funds, for SPVs. What do you think is the most true conventional wisdom now that you've gone through a variety of experiences with regard to fundraising?
It's a numbers game. Like, and you gotta set out and meet a bunch of people and do the work. And doing the work, works. You have to put yourself in the position where you meet enough people that that are that are the right type of person that would invest in your fund, and ultimately good stuff happens.
Phil, I don't know if you, to what extent you want to talk about this, but I'm just thinking, since it's on the theme of what Neil has been asking about, do you want to talk about like the start of 500 FinTech and,
Oh
like
yeah.
when you had trouble fundraising and what you
Yeah,
did to
yeah,
kind of
yeah,
get it
yeah.
off the ground?
Yeah, it's a good call. For a second, I thought you were going to talk about, I thought you were going to compare fundraising for a fund and dating. That's right.
That's a
Like it's a
different podcast.
numbers game. You just got to go on enough dates, and then eventually it works out. Okay, different direction. Yeah, so 500 FinTech. Yeah, it's a good call. So when I started, really, I didn't have the right background. I went into 500 thinking the 500 brand would help me, and it didn't. It was already like a little bit maybe on the decline. So I went out to raise this fund, and basically it was crickets. Like there's no interest from anybody, or there was interest, but it was like corporates who had strings attached or something like that. I basically started pretending like I had the fund. And in order to pretend like I had the fund, I needed the money. So I was personally funding it. And so the first year and a half, I was personally funding every investment we made. And that involved like I was selling stock to fund this stuff to the detriment. It was a good time in the market. So to the detriment of my net worth. But ultimately, I think it was worth it. So what happened was I started investing January of 2016. I didn't raise any money till May of 2017. I did the one close, May 2017. Up until then, it was all coming out of my pocket. And then I sort of paid myself back at cost at that point. And so I was like faking having a fund. But, I think having those initial companies proved that I was able to select good companies. They were able to raise follow-on capital, et cetera, et cetera.
The,
That
the,
got me
the
there.
word fake feels, you were warehousing
I was
your first
warehousing.
investment
Yeah, yeah.
with
Well,
personal capital.
yeah, I mean, but it is like to the point of whether raising for a company or for a fund or running a company or a fund, it is that kind of like hustle, right?
You got to do what it takes,
You didn't give
You
up.
got to do what it
Yeah.
takes. Yeah.
and you got to
I
believe
think
in
you're right, though,
yourself.
because we shouldn't
Yeah.
call it faking having a fund because there are people who actually fake having a fund and don't have the money.
Yes, exactly. And I think like showing that conviction and betting on yourself, it's different, right? When you tell people you're doing that, there's a different response like, oh, okay, this person like really believes in what they're doing. They believe in themselves, as opposed to the person who's pretending to have a fund and not making any investments, may or may not believe in himself, but probably doesn't. To the numbers game, how many people do you think you had to pitch to get the first fintech 500 fintech fund?
A great question. I would guess that I had like 100 conversations, and then we ended up having probably like it was 15 million, and we had a $5 million check and a $3 million check, and then a few like $1 million checks. So that actually it was a small LP base.
Yeah, but that's not that bad. 100 is actually pretty low relative to folks I've talked to raise a first fund.
I think part of the reason it's low is like no one even wanted to talk to me.
Right. How many people did you try to talk to? Let's start there, maybe at the
Yeah.
top of the funnel.
Well, like people, I would ask people to make intros for me, and like nobody would respond. Or like it's not interesting to me. Or I remember some folks seemingly took the meeting as a favor to their friends or something like that.
Yeah, they weren't actually interested. They were just willing to have the conversation.
I guess it was a lot easier when you're able to say like, hey, you can buy into this thing that's already successful.
Yeah, that's basically what happened. So by May of 2017, it's not that the fund was like successful by any means yet, but there were signs like companies had raised follow-on capital from great investors. And so people thought, okay, you know, there's something here. I'm open to investing in this basket of companies.
I think that that's a really good, to go back to the advice, it's a really good truism, right? It's like it is a numbers game. Any number of people may not like what you're doing, and it has something to do with you. It's just where they are, what they're looking for. So you have to keep going to find the people who are interested in what you're doing, and that could be a higher or lower percentage than you expected. What do you think is the most untrue or least resonant conventional wisdom about fundraising?
Some people told us, like, don't do a close on your fund until you have the majority of it closed, the majority of it signed for. And also people told us, like, focus entirely on fundraising, don't do anything else. Meanwhile, like, we kind of did both. We were always looking at deals. And I think that served us well because we knew what was going on in the market. When people asked us what was in the pipeline, we could talk about it. And we actually had committed to our first deal months before we did our first close. So we'd committed to Unit, the banking as a service company, in August or September of 2019. And we said we would lead the round, but we actually didn't have the capital till December. So they fortunately waited for us. And I think that was really helpful. The other thing is we just did a first close with less than a third of the capital we thought we were going to raise. So we thought we were going to raise 60 million. We ended up raising 75. We thought we were going to raise 60. And our first close was 18.6 million. It was smaller than what people told us. Like they said, don't do a small first close. And we did a small first close. And I think it was great because people could take us seriously. I think LPs meet so many first time funds that don't end up ever even doing the fund, that's a waste of their time. So we could just go out and say, hey, like we've done a first close. We have an investment in the books. And I think that was super helpful.
So you guys went from 60 down to 40 initially, but then you upsized back to 75 on the first fund?
We never formally downsized to 40. We just thought at the beginning of the pandemic, the world is different. It's okay if we only raise 40.
Got it. And then a few months later, you realized, oh, actually, and the world also
I don't even
realized,
think it was a few months. I think like we sent out that email and then like interest rates were dropping, the money printer was flying, and like a few weeks later, yeah, I think there's probably only a 5 or 6 week period where like people weren't, we hardly did any fundraising. And then after that, like I said, even people that said no to us reached back out.
Do you think the same advice applies to a founder starting a company? And I'll analogize it in the sense that, like, I think the advice would probably translate into, having like a safe open while you're maybe working on a price round, or doing like rolling closes or high resolution fundraising, those kinds of ideas to just get some capital in the door, get some social proof, keep building the company? Or do you think it sounds like maybe that's not advisable to you, given you like the idea of like compressing fundraising? How do you think about that?
At seed, some of that stuff can be totally fine. I think really have to do whatever it takes to get started and get started building. And if that requires money, then yeah, raise money whatever it takes, apply to accelerators, like do all the things. And so I think that's fine. I think high resolution fundraising is fine too. Like I think a lot of companies have safes at various prices, and it actually makes total sense because something has changed each time. And even having more money is one thing that's changed.
And if you don't need the money, then it sounds like probably your advice would be like get to an inflection point on product, build something, get a customer, prototype, something.
Exactly.
If you could wave a magic wand and change something about how most founders raise money, what would you change?
I wish there was an easier way. Like that, there seems to be like a matching problem where somebody could solve it. And to a certain extent, that's like what YC is doing. Like they're doing an initial filter and then saying this company, here's what each company does. You can choose the ones you want to meet, but they take a hefty cut for that. I wish we had that sort of thing. Um, I I think founders overinvest time. Actually, no, sorry. Founders invest a lot of time in the fundraising process, and they should. I just wish they didn't have to. I
Yeah.
wish they could spend more time focusing on on building the business. And actually, to that extent, I do think founders over optimize. Like I've seen, people just spending so much time trying to get a little bit different valuation or different investor or whatever when they could just be building a business.
I think people tried a lot to solve this problem with like, there's like NFX has Signal, there's AngelList had a product for this. I don't know if it's still around. There are a variety of other places you can go to find investors. If you use Crunchbase or PitchBook, or if there's like funds that have put out lists of investors investing in certain segments, but I find a lot of them have like the garbage in, garbage out problem where the data is stale or it's inaccurate, it's self-reported, things like that.
That's the issue. Yeah. What you really need is somebody that you trust to do the first filter.
And not just that you trust, but like that has recent data and like actual transaction data, like who's actually doing what versus what they say they're doing.
Yeah, exactly.
How do you guys go about finding pre-seed founders or seed founders currently?
Good question. I think there's a mix. A lot of folks, so pre-seed, we invest primarily through the Mint, our accelerator, the mint.vc. It's a
Is
3 month
that
program.
homage to like the karaoke bar, or where did that name come from?
It's not an homage to the karaoke bar, although the karaoke bar is named after the actual mint, which is right behind
Yeah.
it, where they actually only mint this huge property in a pretty good area of San Francisco near DuBois Park that has a huge federal building that is minting. But unfortunately, the only thing that they mint there is commemorative coins. It's not even really a useful space. They should really like turn that into housing, I believe. But anyway, the mint, uh, it was Lauren on our team came up with the name. It was just an idea of like something you start from scratch, like minting a coin.
Mm-hmm.
And we already had green in our color, so it kind of felt good, and we went with the name.
Fintech, bank, bank related.
Yeah, exactly. It's a 3 month program. Uh, the next one coming up is in a couple weeks here in San Francisco, and then we're actually going to do one in New York next year. And the idea is it's a specialized accelerator for fintech. So there's a bunch of specific needs that fintech companies have that a general accelerator may not be best equipped to solve, and we can help with those things. And so we bring in experts from design folks, go to market, tech, all sorts of experts, and then a lot of time with us whiteboarding out solutions. And we work with the companies over those few months, and there's a demo day at the end. And for that side, so that's pretty much how we do pre-seed investing. And we take applications on our website, and I think we get like for the 6 or 7 companies we take, we get about 100 times that many applications. So like we take basically 1 out of 100 of the applications we receive. But actually, it's a little bit different because some of those applications come in through some network, and those have a much higher rate. But how do people find us? I guess was your question. And it's a mix of things. A lot of times it's from other investors. Sometimes it's from social media. Actually, somebody I interviewed yesterday said they saw a tweet I had about David Sachs and then went to my profile, saw the mint, got interested in the mint and applied. So I think,
There is upside to tweeting about other VCs and politics.
yeah, I guess. I try to avoid politics as much as possible, but it seeps in there. But I think those things all help, just like building the reputation.
Do you guys go outbound for the mint ever, or is it's all
We
inbound?
do. Yeah, good call. So we also set up like a LinkedIn campaign that we build around like you worked at X company that we respect in a role that we think is good for a future founder. Um, we just send out a drip like, hey, have you heard of the Mint? And that's led to some good stuff too.
What about outside the mint?
It's actually pretty similar. I think we get a lot of inbound. We get a lot from fellow VCs. I think the associate network in venture is quite strong. There's so
Mm-hmm.
much sharing of deals. So actually, we don't really track it, but I bet a lot of our deals or a lot of our like inbound deals that we take come in from some of our more junior folks. It's a lot of network.
Do you find that the process in terms of what you're evaluating is different for the mint or for the fund in terms of understanding a founder and what they're building, or is it fairly similar in terms of the rubric or the analysis?
We're typically writing a much larger check outside of the mint. And so we tend to do more work in diligence, which is like for the mint, like we're looking at a company right now, and I think we're going to do like one customer call. It's a company that only has three customers. We're going to call them. But I think if we were writing a larger check, we might try to call all the customers. And so it is a little bit different what we look for and what we do. Yeah, I think, investing at a lower valuation, you have more flexibility to do different things.
You mentioned earlier how important like grit or determination is for a founder. Are there other criteria that you think are the most correlated with success, or things that you really index on with founding teams?
I think there's like team makeup where teams that have technical chops have done better. There's the speed of execution, which ideally we see through the process. So, there are companies met a company 3 weeks ago and then have been in touch with them and like I see that the product has improved. They've got new customers. They're constantly stuff is changing. Those are the kind of companies we want to back.
I think it's a really good thing to index on when you are thinking about the approach a team is taking, independent of the team, sort of like the market opportunity or the problem they're trying to solve. Are there things that you like more than others, or certain features you look for, or frameworks you use to analyze those?
Like, are there areas within fintech that we like and don't like?
Yeah, but maybe like zoomed out more, like why do you like certain areas more than other areas is more the question. But let's start with the specific areas.
So we look at everything. We do tend to do more enterprise than we do consumer. We haven't done a whole lot of consumer businesses. And then there are some companies, some areas we try to stay out of. We don't do a lot of lending. And I have a specific belief there, which is like lending companies typically you have to raise equity capital to raise debt capital, and you get some ratio of the equity capital you raise. So like even if you're super successful, you keep on needing to raise equity capital. And if you're the business of venture is a business of growth, and it's easy to grow if you're giving out money. And those that are better at underwriting grow slower than those that are bad at underwriting. So don't do a lot of lending. And then it's just the ultimate like characteristic that we like is, do we think in the long run this is a business that is going to deliver tons of profits? Like that's you wish that valuation of a company was the discounted future cash flows. Unfortunately, that isn't the reality of how things play out. But so we would think about it. Like, is this business going to deliver a lot of cash in the future?
I think that's sounds so obvious, but at the same time, people are making investments where it's like it's a hard thing to see like how this company is ever going to deliver a profit. We could all say that about each other's investments. I'm sure we all have our own investments that sometimes look like that to other people, but I think that's
totally
a fundamental thing that often gets forgotten when you're worried about the team and the quality of the team and they look great, or the idea sounds great, or other investors like this category, or all these other things that are not strong, durable cash flows is the phrase I use internally.
Yeah, I think that's the right way to think about it. And you're totally right. It's easy in this business to say, like, that other company that we don't think is ever going to make money raised a ton of money, so we should invest in that category or whatever. And I've certainly been guilty of those investments too, and they haven't worked out.
What do you think is the biggest difference between the teams that go on to raise a successful next round versus the ones that don't after that first round of financing, whether it's from the mint or from the fund?
There's some aspect of like being in a business that people are excited about. And as an example, we have a couple of AI companies, and the investor demand for these companies is like through the roof. And everybody's pinging me, hey, when are these guys raising? Are they open to chatting with me or whatever? So I think being in the right category helps. Being in the hot category helps with fundraising. Whether or not that's the right place to be is a different story. And then it's really, I think fundraising is a bunch of things. Like being successful is having the right team. So like if you have the right background, that helps. If you've been in a similar company, that helps. The company that's been successful. If you've got the right tech team that helps. Importantly, like, are you in a big enough market where if you are successful, you're gonna get to durable cash flows, as you said? I think that's what it comes down to.
I think there's like, I've heard this for over a decade, but I still think it's underappreciated by founders, the size of outcomes that investors are looking for. And I think it's only gone up over time. And so if you're telling a story of, 100 million or 500 million as an outcome, it's tough for a lot of investors, especially ones who are paying premium valuations at the earlier stages. And you can't be credible talking about building $100 billion business with nothing to your name or no progress. But you do have to also talk about how you can move your way from the initial product set to a second market, to a third market. And there's a lot of things that founders don't realize early on, and they end up learning sometimes the hard way.
Absolutely. I think like building that story, even if you don't have it today, like helping an investor envision what the future could look like is really important.
What's the biggest thing you're working on, or the biggest problem you're facing right now?
The mint has been really good in terms of like we've been excited about the companies, but it takes a lot of work and it's not a huge dollar deployed for us because there's 500K per company times say 6 companies, 7 companies, three and a half million bucks. That's as much as we would invest in one other company. But our time, we're spending a lot of time on these companies. So
Mm-hmm.
trying to figure out what the future looks like there. And I think like we're nimble and we're iterating and figuring it out. But that's as we're like 2.5 weeks away from the next cohort starting, I think that's top of mind.
I'm curious, as fintech has like come in and out of favor, how do you kind of deal with that? And is that something that's top of mind for you?
Oh, it's a great question. Yeah, so fintech certainly has fallen out of favor compared to the highs of 2021. I think, every company was flying high in 2021, but fintech more so than other categories. And then it fell farther than every other category in 2022. And there just like was way less interest in fintech. I think things have come back from those doldrums, but still out of favor. And it has meant that, we've thought about different kinds of businesses that we invest in. When fintech was super hot, every company selling into fintech companies was doing really well. And now we've invested in some other areas like companies that sell into banks and companies that sell into e-commerce companies. So we've shifted the types of companies we invest in a little bit during this time. And the beauty is while fintech has, as you said, like come in and out of favor, the overall macro belief that I have, which is financial services is nearly 20% of global GDP and it's inherently digital in its numbers. I think that belief is still very strong. And like the day-to-day challenges I have with financial services are real and can be solved with technology. So, I think we are building a better tomorrow. Hopefully our companies are building a better tomorrow and financial services is a good place to start. So I'm still really excited about it, but we're investing in slightly different things than we were investing in before.
Every time I have the thought, or I think I even verbalize the thought that like there's not as much innovation happening in fintech, like most of the stuff's already been built that needs to be built. I have some terrible experience personally with financial services. It's almost like the universe telling me like, hey, definitely not true. Like a bank transition that's going to take, multiple phone calls that are hours long,
Yeah,
or weeks, right?
the
Like,
worst.
I think I've also become a little more crypto or DeFi pilled over time. As I
Interesting. We'll have to talk about that.
That's an interesting vector to bring competition to large FIs that otherwise don't need to innovate. I don't know if that's something you guys think about.
We don't do a whole lot of crypto. I think there are certain areas that we do think it makes sense. Cross-border payments with stable coins, I think, do make sense. I think we haven't done a whole lot in the area. I think to do it well, you need to be focused on it, and we're just not.
Yeah, yeah, I think that's fair. Cool. We got a few minutes left, so I'm just gonna hit you some rapid fire questions to the end here. There's a bit of a grab bag. So the first one is, if you had to eat one food for the rest of your life, what would it be?
Ooh, it's either going to be pizza, pretty standard answer I bet a lot of people have, or masala dosa. But I also have this third idea. So you asked for one, and I'm giving you three, which is Amruta and I went to Sri Lanka for a honeymoon and loved it and really loved the food. And they have these like rice and curry dishes that were just amazing. So, all right, I'm gonna go. I got really hungry just now, so I'm gonna go with the Sri Lankan option.
What is the hardest lesson you've learned so far in your life?
Wow, that's a tough question. Hardest lesson I've learned? I've probably learned so many hard lessons. Okay, this business is a buying and selling business. We talked about it.
That's it. That's one you learn sometimes the hard way, and it's a painful thing to learn.
Yeah, totally.
Who are you voting for?
I think Kamala Harris. I think what I'll say is like I have a tough time with politics because I don't agree with the majority of either party's beliefs. And I think, a lot of VCs are coming out in favor of Trump right now, although I think there's like a silent majority that are probably favoring Kamala. I think for me, and I think people have valid concerns with the Democratic Party and feel like the Democratic Party is not serving tech well. I agree with a lot of those concerns. I just personally have trouble with Donald Trump as a person and don't like his values.
We've talked about politics a few times, and I feel like even when we don't disagree, you're very well reasoned and you've thought through a lot of things, as opposed to when I talk to some other people, even when we agree, they just kind of, don't have like a real opinion. It's just kind of like, my team says this, so I say this.
Yeah.
What's been the top moment of your business life?
Ooh, top moment of business life. I think so in venture, everything that goes wrong and everything that goes right is muted. So like, what goes wrong is like a company's not doing well. That impacts you, but your fund only owns 10% of the company. So it impacts you like 10% versus in your startup life, like something goes right, you're like riding really high. And so I would say, I think the auction business that we didn't really get to talk about, but we had some really strong wins that were just so exhilarating. Like we ran these auctions and got paid a percentage and had no idea where they were going to end up, and ended up being hundreds of millions of dollars of auctions. And it was a really cool business that we worked hard at and got to a great outcome.
And that was bootstrap. You didn't have any investors. You were auctioning off TLDs.
Yeah, that's right.
Yeah, that's such an interesting niche business.
Totally interesting niche business. Yeah.
Okay, last question. Who's been the most helpful person to you in your career, and what do they do for you?
I'll give a shout out to my partner, Jake. Jake had co-founded a company called NerdWallet that later went public. And when I met him, he hadn't been working full time for a while. And so going into business, I was not sure that he was the right partner, but actually like in starting BTV, I think he drove a lot of it early on and was like, no, we're doing this. And I was like, okay, we're doing this. And he's been a great partner. Like we complement each other in really great ways. And I think I couldn't have done it without him. And even though we're similar in many ways, like we're different in the right ways, it's been great. So he's been really helpful to BTV, and it's really like a good combo of the two of us and the rest of the team.
Awesome. Well, shout out to Jake. Thanks for joining us. Thanks for being so candid. Amruta, thanks for helping host as well. It was a lot of fun.
Super fun.
Thank you.
Thanks for having us.
Thanks again for tuning in to this episode of Money Moves. If you learned something new or just loved this episode, click below to subscribe. See you next week.